Welcome to the deep dive. Today we're going to cut through the noise, get you the essential insights from Roku's Q2 2025 earnings call and their shareholder letter.
That's right.
Our mission really is to decode all that corporate speak, the financial jargon, and just pull out the most important nuggets for you, help you understand Roku's strategy, their performance, and, what it all means for streaming and advertising.
And it's a really good time to dive in because Roku didn't just meet their Q2 outlook. They significantly outperformed it.
Yeah?
And they've even raised their full year guidance. So this deep dive, it's not just the numbers, it's the why behind it all, this momentum and crucially how Roku plans to keep it going.
Okay, so let's jump right in. The headlines. Total net revenue, $1,111 million. That's up 15% year over year. Pretty robust.
Yep.
But what really grabs me is the platform revenue, $975 million, up 18% year over year.
That's the key number.
Those figures look incredibly strong, right?
Yeah.
Especially now. So they had this 18-month strategy focused on platform growth, profitability.
Mm-hmm.
Where's the biggest overperformance here? What does it really tell us beyond just, the strategy worked?
You're right. It's more than just good numbers. It's clear validation. That strategy, the two main pillars, sustaining that double-digit platform growth and improving profitability. That's what they said.
Right.
But what's really impressive, I think, is their confidence now. Achieving operating income positive in Q4 2025 and for the full year 2026.
Sooner than expected.
Yeah, exactly. This is earlier than what they even said last quarter.
Yeah.
It suggests a real step change in how they're operating, their efficiency, how they're monetizing.
That is a strong signal. Okay, let's unpack that platform revenue growth then, especially video advertising. The sources say it grew faster than the overall platform revenue, faster even than the U.S. OTT market and the digital ad market generally. That's pretty compelling.
It really is.
So what's driving that? Is it just more ads, or are they getting better prices, better efficiency?
It's definitely both. Driven by kind of a sophisticated dual approach, diversifying ad demand.
Okay.
So on one side, they're deepening integrations with third-party partners.
Yeah.
DSPs, right? Demand-side platforms.
Right, the big buyer.
Exactly. Software that lets advertisers buy placements automatically. This is for the larger, more traditional video advertisers who want scale.
Makes sense.
But then on the other side, they launched Roku Ads Manager. And that's targeting a completely different slice of the market, a very lucrative one.
Okay, tell me more about Roku Ads Manager. Sounds like a bit of a shift from their usual big brand focus.
It is, yeah. It's a newer business for them, smaller right now, but it's growing much faster. Why? Because it opens up this entirely new market. It's built for performance advertisers. Think smaller, mid-sized businesses, the ones that usually spend on social media.
Interesting.
Roku actually calls it democratizing television, bringing hundreds of net new advertisers to TV. All self-service.
Whoa.
Look at Fatty 15, that DTC brand. They use Roku Ads Manager, Action Ads, the Shopify integration. Got over a 30% conversion rate from cart ads.
30%. That's huge for TV.
It is. And they even mention using Spaceback to easily make TV ads from their social posts. So it makes it super easy for these smaller guys to get on TV.
So it basically turns like every Facebook ad budget into a potential Roku ad budget. That's pretty clever.
It really expands the definition of who advertises on TV.
Okay. And what about the other side? Those third-party partnerships for the traditional advertisers, how are those fitting in?
Oh, they're thriving too. Roku's got key integrations, expanded partnerships, Amazon DSP, Whirl, Unity through the Roku Exchange, the Trade Desk, Yahoo, iSpot, INCR, and NTL. Big names.
Right.
Their strategies basically work with all the DSPs, customize deals, and importantly, they said, we haven't done any deals that would tie our hands from working with others.
So they're keeping their options open.
Exactly. And the key thing is Roku Ads Manager and these third-party deals, they're completely complementary.
Okay. Lots of room to grow in both. One brings in totally new advertisers, new money. The other deepens the ties, gets more revenue from the big existing players.
Got it. That makes a lot of sense. Two different engines driving growth. Okay, let's shift gears a bit. Subscriptions. What does all this mean for Roku's push there? What about the Frndly acquisition? And just the broader strategy.
Yeah, Frndly. That already had a noticeable impact. About 1.8 points of growth in Q2, they said.
Okay.
And they moved fast on integration. Adding Frndly to the home screen app installs on new devices, indexing it in live TV search, just leveraging that huge Roku reach.
So using the platform power.
Definitely. And for Roku build subs generally, they're really flexing that platform muscle. the home screen, that AI-powered content row that, learns what you like.
Yeah, the thing's pretty good sometimes.
Right. And the live TV guide.
Yeah.
All designed to drive signups. And not just for the Roku channel. They're making it easy to log into Paramount Plus, HBO Max directly.
Mm.
And they ran some big campaigns, too, like that Disney Plus partnership for Andor Season 2. Oh, yeah, I saw that.
And their streaming day campaign drove signups for over 20 partners.
So really using the platform as this central discovery hub, doesn't matter if it's ad-supported or subscription.
Exactly.
But how do they decide what to push? There's so much content now, and everyone's talking about bundling. Must be a tricky balance, right, between keeping viewers happy and making money.
You absolutely nailed it. It's a huge, often invisible challenge. Bundling, yes, massive factor. Roku's focused on improving their bundling capabilities.
Okay.
And deciding what to promote. It's incredibly complex, pushing ad-supported stuff versus subs versus Roku's own content.
Yeah.
They have a very sophisticated algorithm. A whole machine learning team works on it daily. Optimizing yield.
Yield, meaning revenue.
Revenue, yes, but carefully balanced with viewer satisfaction. They say viewer satisfaction is paramount. So it's this constant tuning process to get the mix right for the user and the business. It's definitely not simple.
Right. Okay, building on that platform strength, let's talk the Roku Channel, kind of the crown jewel maybe.
So say that.
Consistently #2 app in the U.S. by engagement, #3 globally by reach, and 5.4% of all U.S. TV streaming time, according to Nielsen. That's a big slice.
It really is significant.
What's fueling that? How do they keep it so sticky?
It's all about that seamless integration, content discovery touchpoints all over the Roku experience. They have features that don't just show new stuff, but they cleverly surface these, like long-tail favorites. Married, with children, army wives. Stuff like that gets pulled up by Featured Free.
Okay. Amplifies the back catalog.
Exactly. Amplifies reach. Plus, it's the exclusive home for MLB Sunday Leadoff. Reach there was up more than 40%. Live sports power.
Yeah, sports always moves the needle.
And Roku Originals are gaining traction, too. They even won a Sports Emmy for that NFL draft doc.
Oh, nice.
All that together. The Roku Channel viewing hours grew, wait for it, around 80% in Q2.
80%? Wow, okay.
Yeah, huge growth.
All right, let's switch to the devices segment then. Sometimes seen as, lower margin. And with things like the Walmart Vizio deal happening, what stands out to you about their device business right now?
Well, it's true. Devices revenue was down slightly, 6% year over year. But what's interesting is gross profit was break even. That was actually better than their outlook. So good cost control there.
Okay, managing it well.
And they're still the clear market leader. #1 selling tvOS in the U.S., Canada, Mexico. Their U.S. share is more than #2 and 3 combined.
Still dominant.
Yep. They launched Roku-branded TVs in Canada. Got good reviews for the new streaming Stick and Stick Plus compact devices.
Right.
And about that Walmart Vizio thing, Roku seems pretty confident. They basically said they can keep growing broadband households globally. And even if they just maintain their current U.S. penetration, which is over half of all broadband homes.
Yeah, that's massive already.
Right. Even just maintaining that allows for double-digit platform revenue growth for years, just from monetizing those existing users better.
So the device footprint gives them the runway.
Exactly. It speaks to the brand power, their distribution.
Yeah.
They're confident they can keep growing monetization on that huge base.
Okay, let's bring it all together financially then. They're feeling good about profitability. What's the trajectory look like for the rest of 25 and into 26? You mentioned those operating income targets.
Yeah, they significantly raised the full year 2025 outlook. Platform revenue now expected at $4.075 billion. That's 16% year-over-year growth.
Solid.
And adjusted EBITDA, that's earnings before interest, taxes, depreciation, amortization, a key profit measure projected at $375 million.
Yeah.
Big number.
Very strong.
And they definitely reconfirmed. Operating income positive in Q4 25 and for the full year 2026, with margins expected to improve further in 2026.
So a clear path.
Yeah, and platform gross margins staying healthy too in that 51-52% range.
Sure.
It signals, sustainable increasing profitability is the plan.
Okay, and one last thing. They approved a $400 million stock repurchase program. What does that signal? Is it just offsetting stock options for employees, or is there a bigger message about shareholder value, especially now?
Well, it's primarily intended to help offset that dilution from employee equity, yes. That's the stated goal.
Right.
But it's also a strong statement. The program runs through the end of 2026. It really reflects a commitment to long-term shareholder value by growing free cash flow per share.
Free cash flow, the actual cash left over.
Exactly. Cash after operating expenses, capital spending, stuff they can return to shareholders or reinvest. And they can afford it. They have $2.3 billion in cash as of June 30th.
Plenty of cash on hand.
Yeah. So that move, plus you hear about positive signs in the ad market, like the upfronts being very positive, advertisers looking for television for performance. It all points to a company feeling pretty confident about its financial health and where it's headed.
So wrapping up this deep dive, it seems clear Roku's Q2 results show a company really executing on its plan.
Yeah, firing on multiple cylinders.
Growing, yes, but strategically expanding into new ad markets, deepening partnerships, leveraging that platform strength, content discovery, subscriptions. It's a multi-pronged attack that seems to be working.
It does. And, as the streaming world keeps changing so fast, think about AI influencing content, ad delivery. Consider this. Roku's dual focus, expanding ad reach to totally new segments and getting smarter with their own data. How might that reshape things for everyone in connected TV? Not just the old giants, but the whole playing field for ad money. Something to think about.